Facing the Risk. Welcome to this week's edition of the Industry Leader Update, brought to you by Reverse Focus. Risk. It's the one thing we should be helping older homeowners reduce, especially in their retirement years. Besides healthcare costs, long-term care, and unforeseen emergencies, there remains one common risk that many homeowners, and yes, even reverse mortgage originators, overlook. HELOCs, or home equity lines of credit. Many of our prospective borrowers already have an appetite for home equity, as evidenced by their history of cash-out refinances, or more notably, an existing home equity line of credit. HELOCs have begun to resume in the mortgage market as home values have nearly recovered from their pre-crash levels and also today's artificially low interest rates. While banks make these loans seem attractive to the average consumer, what is often overlooked or not expressly pointed out are the risks and limitations. First, a HELOC can be taken away just as easily as it was given. Now, if we see another fall in home values, those holding a HELOC could get the same rude awakening that many did in the years 2009 and 10. These unfortunate HELOC borrowers had their existing line of credits slashed or outright closed. Second, payment shock. Those who took out a HELOC in the years 2004 and 5 may now be outside of their interest-only payment period. This dramatically increases their minimum payment, which is now fully amortized. Who needs a substantially larger bill when retired on a fixed income? Also, a default on a HELOC payment could trigger foreclosure, all which brings us to a potential solution, the HECM line of credit. When working with potential borrowers, be sure to ask if they already have a HELOC and the balance and when it began. From here, you can explain how the HECM's line of credit cannot be reduced or closed for the borrower unless they violate the terms of the loan or leave the property. The federally insured reverse mortgage line of credit, of course, has another advantage. The unused line of credit actually grows each month. And now that certainly beats the typical HELOC, which can be frozen or have its credit line reduced. Not to be overlooked is the cost disparity between a HELOC and a HECM loan. While the cost of the HECM is substantially higher, the borrower is purchasing protections, the non-recourse protection, and the projected line of credit growth, which will continue over years. Also, unlike a traditional HELOC, the HECM can transform an existing line of credit into monthly tenure payments without the obligation of monthly payments or the risk of payment shock. Now, a word of advice: if you have a non-borrowing spouse, be certain to inform them that their HECM line of credit is frozen upon the death of the primary borrower. Now, do most of our prospects have an existing HELOC? Odds are they don't, but this group does pose an opportunity for us to take a new approach focused on reducing risk. Now, what are your thoughts on approaching those with an existing home equity line of credit who may be considering one? Leave your thoughts in the comment section below and have a great week.